what we're going to be talking about is the SPX monthly credit spreads trade. And this is a trade that is really easygoing. And I was able to trade it in a pretty hefty career that I had going, several years back. Learned how to trade this, and I've been again. I've tried. I've started this in 2013, and pretty much put on these trades consistently all the time. I always have the monthly trade on. It's a trade that's very relaxing. It's there's a very low stress in it. And what I've got for you today is basically I'm going to share with you all of the trades that I've put on this year, okay, with the monthly trade. And it seems like, people say, well, what are you doing with the monthly trade? It's just, you just sit there and it doesn't, it doesn't do anything. Well, it actually does do something. It actually produces a lot of money. And it does it very, very easily. Okay. So let's get through this. Okay. So now, what can you expect? I'm going to show you basically how to make consistent returns monthly using the monthly trade, which is a high probability trade. And we'll talk about that. And the goal here is not to take large losses and make those returns month over month. Okay. So what are you going to learn? How to select the option credit spreads before the market opens. So you want to be prepared, right? Before when you're going to place this trade, where to enter and exit your trade, how to prevent large losses, have a general understanding for when not to trade, and how to trade consistently profitable. Okay. So please stay with me to the end. There's a special bonus that I'm going to share with you, and you don't want to miss that. So stay with me. And also, if you could turn off all the distractions, there's going to be a lot of information that I'm going to be sharing. And so it's going to be good that you can focus and take some notes. I'm going to ask you also that you'd hold your questions till the end, and I promise that I'll answer all of your questions. Okay. So let's start with, why are you here? Now, I put out 3 reasons. This is the first one. One is you are interested in learning new strategies that will take your trading performance to the next level so that you can finally leave your 9-to-5 career behind. Okay, number 1. Number 2, possibly you've read about others making money trading, and you can do it as well. So let's see here. I forgot to put the video on. Okay. All right. And you're just not seeing your account grow based on your goals. Okay. That's number 2. Number 3 is you've tried different trading strategies that you thought, okay, this is it, only to discover that you're just not getting anywhere and you're not getting those consistent returns that you expect. Okay. So if you can just let me know from 1 to 3 or all 3, which one of these fit you the best, just let me know real quick. Okay. Thanks, Gary. Number 3. 1. Okay. Thanks. Perfect. Number 3, all 3. Awesome. All right. Perfect. Thanks, guys. All right, so I'm just a regular guy. I am full-time trading. That's my wife and myself on the left-hand side. I have 5 kids from my first marriage, and that was my oldest son's wedding, and then my parents, and that was an MBA program that I went to. So I was in IT for a long, long time. Did some financial stuff, and then was able to break free and trade for a living. So the mindset is one of the most important things to have as a trader. So I want you to imagine how it would feel like if most of your trades were winners month after month, and it would be confirmed by watching the size of your account grow at the same time. Now, what I'm going to be sharing with you today is just the monthly trade. Now, I trade a lot of other things as well, but today I'm just going to be talking about the monthly trade. And again, I'm going to walk you through every single trade that I made this year so far on the monthly. Okay. So the second part of this is becoming the trader that no longer takes large losses, but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account month over month. All right. So again, I started trading these in 2013. I made a ton of money and I lost a ton of money. All right. And it wasn't until I finally got really serious with it and, focused on my trade plan over time. And so far, so good for the past 3 years. It's working really well. Okay. Ups and downs in the market. There are some times that you take losses and you move on. But over time, my consistency has actually gotten much better. Okay. So let's talk about what is a credit spread. All right. So for those of you who are not sure about what these are, all right, a credit spread is a combination of 2 puts or 2 calls where a put or call that is sold is more expensive than the put or call that is bought. So what you're doing basically in this case, right? This is a 30-10, 30-05. So it's a 5 wide put spread, and you can call it a bull credit spread. The 30-10 is the 30-10 strike is the one that you're selling, and the 30-05 strike is the one that you're buying. Okay. So because the 30-10 is more expensive than 35, you're actually receiving a credit, in this case of 45 cents, based on the strike prices that they're there. Okay. So it is considered a high probability trade, right? And the reason for that is because you put on these trades, you receive a credit, and the profit is there, already. That's the max profit that you can receive, and in order to lose that, the market has to breach through that credit spread, and that's really the way that you lose. Okay, so it is a high probability trade, but the risk reward in this trade is very poor. So in this case, right, you're risking $5,000, and the reward basically is 450. All right. So you're making very small amounts based on what you're putting up, and you're doing this over and over and over again, right? But again, the return on this is small, but the probability of winning each of these trades is very high. Okay, and I can tell you that I put on many trades this year, and I have not taken one loss in any of those trades, right? So so let's move on here. All right, so let's talk about option decay, which is one of the greatest profitability factors in this particular trade, right? So the option here from 68 days to 33 days, the rate of decay is 34%. From 33 days to 5 days, the rate of decay is 57%. And from 5 days to expiration, it's 100%. Okay, so I trade 7 DTE trades as well. And so the rate of decay for those 7 DTE trades is dramatic. Okay, so I'll put on one trade, and as long as the market stays within a range, I usually get out within 3 or 4 days for at least an 80% gain on my credit, that I received. All right. And this happens over and over and over again. Okay, so let's talk about all the profitability factors. One is implied volatility. When I put on trades, I like to put them on when there's a spike in volatility, and usually at the very open of the market, because that's where implied volatility is the highest. Okay. The ideal setup is you're selling your spreads, your credit spread, when the volatility is high, and you're closing them when the volatility is low, right? So the other factors besides implied volatility is theta. Theta is the rate of decay that an option goes through. And so, for monthlies or 7DTEs, this is very, very important, because as the option nears expiration, it decays much more. It decays faster and faster and faster, right? And that's where you're able to close that trade with a nice profit, right? And we'll talk about the profit. So the other part of this is market direction. Now, which way is the market going most of the time? Most of the time, around 60 to 70% of the time, the market is moving sideways to high, all right, to higher. So it generally the market moves up, consolidates, then moves up again, consolidates, moves up again. So it's a constant process of this happening. Now the market does at times move down, but it's typically about 30% of the time that when the market moves down. Okay, and when it does move down, it moves down quickly and aggressively. And so you want to make sure that you're out of the way when that happens, especially with a credit spread, right? And we'll talk about how you get out of the way on that. So first, let's discuss risk management guidelines and daily routines, okay, that I go through. So number one, you always trade with a plan, right? You want it to include entry, exit criteria, and composition, and when not to trade, right? And when not to trade is like if there's a Fed day and you don't know what the result's going to be, and you're trading an instrument that's close to the market and like a 0DTE trade, that's when you don't want to trade, okay? Because you just don't know what's going to happen. So it's that's an example. So in this trade, you want to determine your max loss and risk reward before entering the trade. And there's criteria that I use for how much margin, how many contracts I'm going to use depending on the account size. And so a general rule I have, and I trade 3 different instruments, right, for credit spreads. I trade monthly, 7DTE, and 0DTE. And so in a $10,000 account, I would trade 1 contract per 10,000 on monthly, on 0DTE, and 3 contracts for 7DTE. That's kind of what I do, all right, for these trades. And so if you're trading just the monthly, let's say, then you can put those together, right, and trade 4 contracts, for 4 or 5 contracts actually for just the monthly trade. Okay, so that's kind of the rule of thumb that I use for trading this. All right. And here I say not more than 20% of your credit margin, for your trading capital. All right, as a general rule. So in addition to that, you don't want to take more than a 2% loss, based on the trade. So if your account is $10,000, you want to limit your losses to $200. All right, it's a general rule. For highly trending markets, position trades to follow the trend. And I mostly trade put spreads, which are bull spreads, right? Because bull spreads are much easier to adjust if they get threatened than bear spreads. And so, and then I trade smaller positions on my bear spreads. Again, just because when you have a bear spread, you're going against the market basically most of the time, all right? And those can be challenging to manage. Never hold short-term credit spreads overnight. And when I talk about short-term, I'm talking about 2 to 3 days, basically, and depending on how close you are to the money, in these particular trades, right? Size your trades to ensure that emotions are not part of the decision-making process. If you trade too big, your emotions get affected, right? Because you're thinking, oh my God, I'm going to take a big loss. I could take a big loss, and if you trade small, relatively speaking, your decisions will be clear and not emotional, right? So that's very, very important. All right. Pre-market routine, I'll review areas of support and resistance. And when I share the charts here, I'll show you what I use. I use Fibonacci retracements, which is a great tool that many traders use. And so that's why they can, the support and resistance areas are very common, and where the congestion takes place in a market. Okay. Review the dollar. The dollar has a lot to do with the S&P 500, because most of the revenue that comes out of the S&P 500 is from overseas. So when the dollar's high, prices prices are higher for overseas purchasers. When the dollar's lower, they're lower, and so there's better price earnings when the dollar is lower. Okay. Treasury yields, when bond rates are high, the rates, they compete for money out of the stock market. And so, as rates move higher, it puts more pressure on the stock market. So it's important to understand those nuances and correlations, right? Also review the ES futures, like tonight. They're moving down, and that you have to watch for that, when you're trading credit spreads, because you don't want to be too close to the market when the market's moving aggressively lower, because then overnight you don't have any way to adjust your position, and so you always have to be cognizant of that. With monthlies, you're almost always very far from the market, so it doesn't affect it that much. Okay. The VIX is the volatility index for the S&P 500, and so obviously that's an important indicator to understand and watch. And again, you want to put on your credit spreads when the VIX is higher, and take them off when it's lower. And then be prepared all the time when you're putting on positions, and we talk about delta. We'll talk about delta here, and how to position your trades. So you don't want to throw it out there, not thinking about where the market's going to go and where your support and resistance areas are. So it's good to understand where those areas are before you're putting on those trades, to make sure that you're okay. Okay. So post-market routine, determine if rules were broken and why. Determine if risk was within acceptable levels, especially for your wins. Sometimes you can make mistakes and get lucky, right, for a win, but that generally results in later on complacency, and you don't want to have complacency. Because that's where your big losses come from. Determine if losses were within acceptable ranges, right? So you don't want to take big losses or small ones, because if you take big losses, that affects you emotionally, and it really does affect your trading after that. If you're trading with fear, you're wanting to take off positions before, if you see a loss, right, you want to take it off quickly, so that you're not scared of making big losses. So fear and greed are things you want to keep in check all the time. Determine if tweaks or adjustments are to your trading plan is necessary. And I do that often. I check and make sure. And recently I did make a small change to my trade plan, just because of the well, I'll share that with you in a few minutes. All right. Okay, so let's actually talk about the SPX monthly trade, and this is really the basic trade plan for it. Okay, so my entry is between 30 to 60 days to expiration. Sometimes it's a little bit less, depending on what positions I had on and what changes I'm making. But if generally when I start a position, it's typically 30 to 60 days, and a lot of times it's around 45 days when I start. Okay, bear spreads should be entered cautiously with a hedge. In a hedge, sometimes I'll use a debit spread on the end of a call spread to mitigate a potential threatened position. And so depending on the market, I may put one on or use a lower delta and smaller positions to do that. Okay, so for the bull spread, I use a 10 to 12 delta on the short leg. Okay, and for bear spreads, I now use 5 to 6. I used to use the same 10 to 12, but now I cut that in half. Okay, so and it's working really, really well actually. So I use a 5 to 6 for bear spreads, and the premium, and this is for a 5 wide, is 30 to 45, and generally I'll take about 65 to 70 for a 10 wide position. And when I say 10 wide, I mean like 40, let's say 4,000 and then 4,010, right? That's a 10 wide position on your strikes. All right. Take profit. I take profit generally 80% of credit received. And so if I put on a trade, let's say that's for $1, right? I like to take it off between 50, basically from 20 cents to 50 cents, right? And a lot of times, if I use a credit spread, I'm using 70. A lot of times I'll take it off at 10 cents. Because from 10 cents to expiration, from 10 cents to zero, it could take a long time, right? So I'm constantly closing these positions out and not letting them expire. Time is risk on these, all right? So for positions that have been rolled or adjusted, basically once you've mitigated a position, the delta is generally higher once you mitigate that. And it's higher typically because the market has already moved in one direction quite a bit. And so what you're trying to do when you mitigate it is you're trying to move it away from the market, and you don't have to go to the extreme of another 10 delta. It could be 20 or 25 delta, but because it's closer to the money, you have to be cognizant of that, and you want to get out of that trade as quickly as possible to mitigate any kind of a big loss that you may have. Okay, so don't always try to get the maximum profit. It is acceptable to allow a trade to expire worthless, and just a quick note on the monthlies. The monthly is an AM settlement. Okay, so basically most other options basically settle at the time that they expire, all right? Not for the AM expiration of the SPX. These are European style options. And so what happens is on the third Thursday of every month at 4 p.m. Eastern, right? And if you have a option open, basically the option halts at 4 p.m. on Thursday, the third Thursday. You have no control after that point of what happens to that option. So the market could tank 100 points, and the settlement happens at the open of the S&P 500 on that third Friday. Okay, and this has happened to me. That I went to bed and my position was out of the money by a lot, and I woke up and the position was in the money by a lot. Okay, and that caused a very, very large loss. And from that point on, I said I will never ever have a position open before it expires. So I always close my positions now. Initiate a roll between 2.5 to 1.5. This one's a little bit, it's kind of a rule of thumb. It's not hard and fast, but I usually go a little bit higher than 2.5. I usually go between 3 to 4%, and then I start managing the trade and rolling it for monthlies. Okay. And stop loss, there's really no stop loss. However, there are times when, especially like a bear spread and the market's really aggressively moving higher, if I can get out of, if I can get out of that trade without having to adjust it for a small gain or a small loss, I'll take the small loss and move on, instead of trying to mitigate every penny that, that goes against me. And so it hasn't happened this year. And we've had, pretty nice, strong gains. But when I put on my spreads, I always put on the bull spread first, wait to see what happens. If the market goes, aggressively higher, I'll go ahead and put on a half position for the call spread. That's just an example. And remember, I use half the delta for that. And so I can get wide distance from the market with a smaller position. And that's really the way to go. And it's worked out very, very well. Okay. Okay. So I'm going to walk you through an actual adjustment that I made, and it's from 2018, but it's relevant. Okay. And this one was when the market, went down quite a bit. I had to adjust the position. So that was the position. And you can see here that the amount of distance that it has on the call side compared to the put side is very, very, very different. Okay, so it's 100 points more, and the reason for that is because when the market does move down, it moves down more aggressive than moving up, and usually moves a greater distance. Okay, so the options are priced that way, and that's just how it is. Okay, all right. So once the position is threatened, you can see here I had a 21 delta, and the premium moved up to 90, and this went down to 4 delta, and the premium went down to 5 cents. So what are the steps to mitigate this? Okay, all right, let's go through that. So the first step is to buy back the non-threatened position. Okay, so you buy it back. I bought it back for 5 cents. Now you could roll it, but what happens is that if you roll it, you're moving your position into another. If you're not moving it, if you're moving it within the same month, it's fine. But if you're moving it to another month, you're actually creating another margin requirement. So you double the margin that you need in order to trade that position. So I just close it out, and then I basically mitigate the threatened position. And in this case, what I did was I closed the 24.15, 24.10 position and opened the 23.40, 23.35. Now you can do this in 2 steps, or you can do it in one trade. Okay, and some brokers don't let you do it in one trade, but most do. And when you do it in one trade, you know exactly what you get out of it. Okay, so you don't have any slippage, and you'll know the net result of the adjustment. And in this case, sold. Basically bought the 24.15, 24.10 position for 90 cents, and I sold the January 23.40, 23.35 at 90 cents. So it was a wash. Okay, so it was a debit of 0. And in this case, it would be a vertical. It's called a vertical roll. Okay, if you're rolling it from one month to the other, they call it a vertical roll. If you roll it from one strike in the same expiration to another strike, it's called a condor. All right, and that's how at least that's how Thinkorswim manages the trade. So in this case, then now I opened a new position in January and collected 50 cent premium. So basically, the cost I actually received a credit of 45 cents for that position because I had to close the one for 5 and get a credit for 50. And so I ended up getting an additional 45-cent credit on this, and the premium collected, compared to 70 cents initially, was 115. I had closed the trade after that for I think 10 or 15 cents. So it was a good mitigation. Doesn't always happen this way, and this is a result of the position at that time. Okay, all right. So this session is recorded, and so you'll be able to you'll get the replay on this as well. So I'm going to take you through now my trades for 2021. Okay, and I thought this was the best way for you to actually visualize and understand, when I put on my trades and what I use to do that. And so, so let's go through that. Okay. So in January, the first trade I put on was a put spread, and it was 34.25. 34.15. I put the pricing on the right hand side, so you'd have an understanding of where that is in the market compared to the range. Okay, so you can see there at 34.25, 34.15. It was quite a ways down from where the market was. Okay, and I collected 85 cents on that. You can see also here that I put on a February position, right? This was the February expiration, and I put it on well before, obviously, the February and the January. Okay, so it was about 45 days out, or probably a little more. Okay, when I put it on. All right. So after that, I actually, the market went up, and so I actually closed the position for 30 cents. Okay. I do that when I get a quick, pretty quick move in the market and take advantage of that, so I can put on another one within the same expiration. That's exactly what I did. So after that, after I closed that one out, the next day I put on a call spread. Okay. And I used the delta was lower, so it was 55 cents. And then after that, I went ahead, after the market went down, I went ahead and put on another put spread and collected 70 cents. Well, the market went up, and on February 8th, so we went from the 27th to the 8th, right? It seems like really fast here, but when you're trading, I mean, the 27th to the 8th, that's more than a week, right? And so I collected, basically I closed the trade for 10 cents at that time. And then I sold another call spread for 65 cents for March. So this started the March expiration cycle. Now, why did I put it on? Because, the market went up nicely, and I wanted to take advantage of being far away, from expiration, so that I can get a good price. So I got a 41.70, 41.80 call at 65, cents. I left my other call spread on because it was already really close to expiration, and I knew that I had an order in to close it for 10 cents, and on the next day, that's exactly, well, it wasn't the next day. It was a few days. It was actually the 9th. Yeah. No, the 10th, the 12th, actually. Let me see. I put on a put spread. And so let me see what happened to this one. There it is, right there. Okay, so I closed the call spread a few days later for 10 cents. And again, I knew that we were very, very close to expiration, and so I left the two call spreads on simultaneously. I don't usually do that, but in this case, I did. Okay. Now on the 19th, I went ahead and bought the 4170 call spread. I closed it for 35 cents, the one that I had put on, and for 65. So I collected 30 cents and closed out the call spread. I like to close out the call spreads as quick as possible. And so I don't wait a lot of times till 10 cents, even though in this case I did, just because we're really close to expiration. But I usually close them out at 50% of credit, okay? And on February 26th, I added another call spread at 55 cents. And you can see where I put it on when the market was going down, okay? I thought it was going to go down, but right after I put it on, it went up, but then it went down after that. And so when it went down again, I was able to close that call spread for 15 cents. So you can see how expiration and market, direction really has a lot to play in this, in this trade, right? And again, you're looking at, days and days that go by, but here it looks really, really fast, but it's not. It's a very, very slow and methodic trade, okay? All right. All right. Again, I'll answer all the questions at the end here. Let's just go through this, okay? Okay. So I then put on a call spread again at 45 cents. Again, this was, the delta was around around 5 or 6 at that time. Okay. Then what I did was I took I took the trade that I had on before, which was the 35.50, 35.40 put spread. Okay. And since the market went up and expiration, expiration was getting close here. It was about a week or maybe 10 days out. I actually moved my very profitable position and I moved it up. Okay, I rolled it up within the same expiration, so it's a condor. Okay, let me take you back real quick just so you understand. So where is that trade? It's right here. Okay. On the 12th, I put on the 35.50, 35.40, 35.40 for 65 cents. All right. So let's go forward here. I'm sorry. And here's the condor that I rolled it up. I rolled it up to 37.25, 37.15. Right. And so you can see that we were still quite a ways from the market as it was going up. All right. And so I decided to collect another 40 cents within the same expiration. On March 15th, I closed the call spread that I got for 45 cents. So netted 35 cents on that. On March 18th, I sold a April 36.75, 36.65 put spread there. And that was for April. And this one's for March. Okay, so I did close the March one. I just want to make sure it's not here, but I did close the March one. Okay. So I'm missing a trade here. Sorry about that. But in any case, I did close the, it seems active. I know it seems active, but it's actually it's a pretty slow trade when you're just trading this day by day. All right. So I did another condor and collected another 30 cents within the same expiration. And then on April 7th, I closed out the put spread for 10 cents, the 37.75, 37.65. And then I opened a half position in a lower strike, basically, it was like a 9 delta on this 37.25. And the reason I did it here was because the market was just relentlessly going up. Okay. And all the news was good. Everything was good. And so I wanted to at least get in quick, early. And I generally don't do this. I wait for a pullback, but in this case, I decided to put on a half position. Okay. And I'll show you what I did after that. So I put on that half position, right? And then I sold a call spread, because I wanted to, catch that move higher up, and I thought eventually it was going to come down a little bit or at least go sideways. And that's why I put on a call spread. Then I actually put on another put spread, right? At different strikes. Okay, same expiration, different strikes. Okay, so I had three contracts in one position and three contracts in another position for the same expiration. All right. Then what I did was I actually closed out the original 37.25, 37.15 for 30, and then I added to the 38.25, 38.15. Okay, so at 45 cents, the market didn't go down. So on that red candle day right here, I took advantage of getting that position on. So I had 6 contracts now in the same with the same expiration, and that was what I was shooting for. Okay, then the market continued moving higher, and I was able to squeeze out another 20 cents out of this expiration cycle, and then closed the call spread that I had put on a while back. And you see here, I put on the call spread April 14th, and I closed it out on May 11th. That's a long time, right? But it got really close to expiration, and I closed it for 5 cents. That's probably the lowest you can get. Okay, and then I closed out the 39.25, 39.15 for 5 cents as well, and then I put on now we're at 7 contracts. So you remember I started with 5 and I'm ending with 7. All right. So my account actually moved about 20K during that period of time up. Okay. So I put on a 37.75, 37.65 at 65 cents. And and then I put on a call spread, half position, because the market was continually moving higher, for 45 cents, right? And then I closed the put spread for 30 cents, which was a little bit better than 50%. And I put on a call spread way up there, 43.75, 43.85, and actually closed that position this week for 25 cents, I believe it was, either 25 or 30 cents. Okay, so that was my activity. That's been my activity. That was my activity for this year, right? On trading monthlies. Again, the trade, it seems like it's a lot of activity here, but it really isn't compared to my 7 DTE trades, which I trade a lot more. And so, but you can also see that every single position was profitable. Okay, this doesn't happen all the time. Sometimes I have to adjust positions, right? But if you're in there and you're trading every single day, you become one with the market, and it just works. And these trades are very, very favorable, to collecting income. And again, you don't have to do what I do. Okay, you don't have to, roll trades up and to squeeze out more premium. I didn't do that when I was working. I mean, I would just put these on and just let them go, and just let them go. And month after month after month after month. And sometimes I'd have to mitigate, and take a few losses here and there, but month after month, it would give you income. Okay. All right. Oh yeah. And this is the position that I'm holding right now. This is the only position I'm holding right now for June. I don't have a call spread right now, but I will probably be putting that on. Okay. All right. So just a quick note on technical analysis. I use fibs, and You saw them in the, you saw them in the, let me go back here. You saw them in the ranges here. This is actually a fib retracement that I use on the daily, right? And you can see where, the market congests around those areas, right? And so anyway, that's why I use it. And it gives me an understanding of where there's going to be support and resistance, etc. And so this is a 5-minute, okay, and I'm showing you this just to illustrate where congestion results, right around the fib areas, and I drew this from the top to the bottom when this happened, all right, when the market went down, we got a bottom here, and you can see how the market retraces to these different levels. And so if you're going to use one indicator, use the fibs and learn how to use those, okay? And there's fib retracements and fib extensions, and they're phenomenal for futures trading, right? You can't do it without it. All right, so that covers the trade plan. I wanted to share with you a program that we put together using the monthly, the 7 DTE, 0 DTE, and then other trades that we do, okay? I started, along this path because I knew there was a faster and better way to get, to get going on a strategy that will really, really produce income. Okay, and 800 people have come through our doors. All right, in a trade alert service that I put together, and I set out to create a course, and I did create a course, but I set out to do that, but what was happening was, a lot of people wanted to trade this strategy, so we opened up a room and started calling out these trades, and long story short, we developed an instructional trade alert service where you learn how to trade these trades, and eventually the goal is to make you independent so that you can trade them on your own. Okay. And many people have gone through it, and many have gotten there. So and it's a really low cost way. And trust me, I've paid thousands, hundreds of thousands of dollars to learn this thing, and it took me a while, but now that I've tweaked the trade plan, and obviously you have to be a trader that you have to take it upon yourself, to do what your style of trading is. Okay. So, obviously there, and there's guys that trade differently than I do, and they're doing very, very well. All right. So the question is, if you're interested in learning new strategies, and, we talked about this right at the beginning, maybe you're not seeing your account grow month after month. You haven't found the right strategy. The thing is that it takes work. It just takes work. And the question is this the time that you want to break those barriers? Okay. Are you going to keep doing what you're doing? Hope that it someday, right? Another trader, another guy, a friend of mine said, hopium, right? It's not a trade strategy. You're hoping that someday it's going to stick, or do you want to finally take the steps that'll get you to a place that works? It's a proven methodology. For years, I've been trading this, and it does take learning, training, instruction, practice to reach success. But in addition to that, it does take discipline, commitment, having an edge, right, and a no quit attitude. You're gonna have bad days, right? But you got to shake it off and move on. And you gotta make sure that those bad days are not big bad days, right? You don't want to have big losses. So all of this, I'm telling you, it leads to success. It really does. I didn't make up those trades that I put out there. Those are my actual trades that I traded this year, right? And I will continue to trade that. And I had to adjust 7 DTE trades in March when we had that 5% correction. I do make mistakes at times. I adjusted that trade too late. It cost me, right? And it cost me a loss. It was a loss in that trade, and I think it was the first loss in for 7 DTE trade that I had. But in any case, we have a program where my trades are actually the trade alerts. They're integrated with the trade alert service that we use with Telegram, and they're posted almost immediately from my account when it comes in, right? So if you're getting started, it's a great time to learn. If you're already a seasoned professional trader and you want to learn a new strategy, it's perfect. You can adapt right into it. Okay. And, our trade alerts help you get to that highest level, right? We have 3 or 4 other traders that we trade with, right? That do different things. And we're very disciplined in our approach, and we're consistent profit. We make consistent profits month after month. Okay. You can get there. Our trade alerts will help you trade at the highest level. It's designed to transform your trading from uncertain to predictable and teach you how to generate those returns. Okay. So we have chat groups that are 2-way communication, and we have channels that are 1-way communication. So there's no ambiguity in there in those channels, right? The trades come in very, very clear. If you have questions, you can reach out through the chat. And we're always there to help, especially if you're new to making adjustments on trade. We teach you the process of getting through that as well, right? Again, we have channels and the success stories. We have tons, right? We have that are not all here, right? Matt, I worked with for several years and turned him on to option trading, and he loves trading iron condors and verticals now. Luke has been with us for about 2 years in our trade alert service, and learning something new every day, and he loves the service. And Emmy joined us about 3 months ago, and he loves the community and what we're doing, and he's sticking with it and loves the training that he's getting. Dwight's no longer with us, but he was with us for over a year. Learned how to trade all the different trades, and he's doing that on his own now. Okay, so what is it that you get? Well, first of all, you get my guarantee, right? It's a subscription service, and if you subscribe for 1 month and lose money by following my trades, I'll refund you the subscription plus 25%. Right? I've never had to refund anyone so far in over 2 years. These are the costs. These are the standard rates, all right? But what we offer is, and I'm putting this up now, right? What we offer is a 20% discount for life on these costs here, all right? Can't promise that the cost is, I'm trying to keep the cost low, but we're bringing in more professional traders and more integration. But we're trying to keep the prices low, and you guys have looked out there, I'm sure, right? I don't think you can beat this, and even for an entry, a lot of people start at the 39 and trade the monthly options. And you saw, if you total, you're going to go back, I'm sure, and look at the totals on those, right? I mean, that's a lot of money that was produced over that period of time, just on the monthlies. And again, we do futures, we do 7DTE, we're doing calendars and debits and all different option trades as well. All right. It's just a no-brainer, guys. All right. In addition to that, I did create a course. It's a credit spread course, but it brings in all the trading disciplines that you need to have in order to be successful as a trader. All right. This course, it's about a $400 value. The reason is because when I started this, and people asked me to mentor them, I charged them $800, and I know people who have charged a lot more than that. But this was one-on-one mentoring for these specific trades, and it costs $800. So I took that information, and learned from them, right, what they needed and what was important, and then I created a group coaching and that costs $400, and the course value is $400, and the regular price that we have is $149. So the price of the course basically, it encompasses way more than the mentoring that I shared with these guys, and actually you can get it for $129. Okay, so what we're asking you to do, and the thing is our trade alert service is not open right now. It's going to open the first week of August, and the reason we do this is because when people come in new, right, they're asking a lot of questions. They're asking for help and training and all that. If they come in one at a time, we're always going to be distracted, trying to help them. All right. So what we did was we closed the service for 3 months at a time, and then we open it and we bring everybody in. Right. They ask all the same questions. We deal with those questions for about a 2-week period, and then everything's cool. Right. Then we can focus on our trading and the traders in there. Okay. So again, the course is $129. If you want to purchase it, if you don't, that's fine. We open the first week of August, so it's a great time if you're new to, especially new to credit spreads, to learn everything in the course and then get in the trade alert service. All right, and a lot of people join, and they, actually most of the people join, they stay in for 4 or 5 months, and then they go. They've learned what they want to learn. We teach them. I mean, we actually have live trade rooms where we talk about Elliott wave and ABCD patterns and support and resistance and how to measure that and monitor it. And so the thing is, if you want to learn a step-by-step process to gain income in the market that goes up and down and finally break those series of losses, you want to earn consistent income, this sets you apart from other traders for sure. All right, it gives you that edge that you've been looking for. Again, what do you get? 20% off when you subscribe to the wait list. There's no charge for the wait list, and at the end of the time when we open, right, you don't have to join, right? But if you get on the wait list, you get an exclusive entrance 1 week early, right, into our trade alert service, and you get the $20 off for life. You get training and education, and we've really enhanced that over the past 3 months. Automated signals, as I mentioned, they come from my account, most of them. Price target, trade entry prices, price targets to get out, and my guarantee. Right, it's a winning combination. Again, you can't go wrong, guys. Right, so. I said I would answer all the questions. Let me go up here. And let's see where we're at here. Okay. So I'm closing the trades when the delta, well, no, once I put the delta on, then I really don't refer back to it. Okay. It's just managing the trade and letting the decay happen. To it, and you see the premium go down little by little. So for a 10K trading account, maximum 4 contracts, 10 spread. Yeah, that's about right. 4 to 5 contracts, I would say. You can do. If you have a smaller account that you're not real concerned about blowing up, then you can put in $1,000. And I've done that. Okay, I put in $1,000 and then I trade one contract for 3 or 4 months until it grows, and then I added the second contract. But in any case, it's a small contract. I'm in a different time zone. Do you have trade copy service? Ooh, that's a good question. I don't know what that means. A trade copy service. Can you expand on that a little bit? Asian time zone. We have people from Singapore, from Denmark, a lot of places in the globe. What we don't have a lot of people is from New Zealand. Or not New Zealand, but what's that other place? I can't remember. Way in the south. Let's see here. Difficult to see open U.S. market over. Yeah. Challenges. Alerts would come while we're asleep. Yeah. Actually, I trade futures at night, and so sometimes I'm trading in the middle of the night. So okay, APAC, yep, yep, yep. We do have a lot of people from Singapore. That's in our group. Yep, the recorded webinar is going to be sent to you guys. Any other questions that you have about the trades or anything else? You will get a replay on this. You can start with $2,000. Our recommendation, the lowest is 3,000, but you actually can start with 2,000. However, it's tough because if you're trading 10 wide, you can only do a maximum of 2 contracts. Should adjust the trade immediately or any room for a few hours being? Oh no, yeah. On the monthly, yeah, the monthly you can take your time in adjusting the position. The 70 TE, not really. The 70 TE you need to do pretty quickly. Australia, there you go. Thanks, Chucky. Yeah, Australia is really a big difference on there. Oh, the VIX comment about not trading. Well, no, the VIX. I think you may have mixed up the two. About not trading is like when there's Fed minutes coming out or something like that. That I won't trade 0 DTE during those times. The VIX basically. The VIX you want to put on trades when the VIX is higher, relatively speaking, and get out of the trade when the VIX goes lower. Okay, so that's volatility index. Okay, theta is actually the rate of decay an option goes through, and so the closer it gets to expiration, the faster the rate of change of decay that option will go through. Okay. And it's not just the option decay, right? Market. So if you're in a bull spread and the market goes up, obviously the premium is going to shrink as well. And so you use that in your favor as well. I like to put on positions early in the morning because that's the highest implied volatility time, the first half hour of a trading session. And so I use that a lot of times for 70 TE. I'll put them on very close to the open of the market. No, I usually, well, you saw, right, in the trades that I had, a lot of those trades I closed at 10 cents, the call spreads I close early just because they're the hardest to manage, right? So when I see a profit on a call spread, I close it out as fast as I can. And a lot of times I'll do it for 50%, but the put spreads, I'll do it at 80%, pretty consistently. What's the recommendation on minimum? Yeah, I always say $3,000 really should be the minimum to get in. The max drawdown, yeah, the max, it gets scary. I'll tell you right now. You just can't look at, a lot of times with credit spreads and the market goes down really quick, you can see thousands of dollars just in the red, right? And that kind of freaks people out. But I don't look at that. What I focus on is the mitigation that I'm taking the positions through, right? And so the focus is to get the positions away from the market in a safe place and then let things settle, right? And so you need a cool head, and you don't, you just don't look at your account during those times. That's what I do. I focus on the adjustment. And a max drawdown, I've had $30,000-$40,000 drawdowns before when I was trading larger positions. And again, you don't focus on that. You focus on the thing that you need to pay attention to, which is the adjustment. I don't set stop losses on these. If I do take a loss, maybe on a call spread, I'll close it. I'll close it for a small loss or a small profit. Repeat the comment on choice of bull or bear credit spreads. Well, yeah, if you're going to trade one side, trade the bull side, right? Because it's a lot further from the market, and the market is generally going up. And so, if you're going to trade a vertical, not an iron condor, you trade the bull spread. The bear spread, which is a call spread, is the one that's that can get threatened the most and the most difficult to mitigate. For the 129, you guys have access to it. So as long as you can take your time on that, so you'll have access to it. I think that's right, Stephen, right? For that. Oh, by signing up for the waitlist. Okay, so you sign up for the waitlist and then you get the 129 course. Okay. Any other questions? Okay. Well, the 70TE is 10 to 12 as well. That's what I use. The same delta on the 70TE. We have a trade plan. If you go to the Facebook group, you can download the trade plan for yourself, and it gives you the trade plan for 0, 7, and 30 day expiration. Okay. Any other questions? Thanks. All right. Perfect. Great. You too, Chucky. Thank you. All right, guys. Thanks, and have a good night. Thanks for your time.